Welcome back to the channel. In today's video, we are going to talk about one of the most powerful concepts in investing, that's compounding, and why it's absolutely essential to your success in the stock market. Now, you have probably heard the term compounding thrown around, and what does it actually mean? And how can you use it to build wealth in the stock market? Let's break it down. Compounding is the process where the returns on your investments, whether it's interests, dividends, or capital gains, are reinvested to generate even more returns. In simpler terms, you are earning returns on your returns. Let's say you invest 1000 rupees in the stock market, and on an average, the stock gives you a 12% return each year. In year 1, you make 120 rupees. But here is the magic. By the second year, you are earning 12% on not just 1000 rupees, but you will be earning interest on 1120 rupees. And not on just your original 1000 rupees. Your returns start to accelerate. Imagine that process continuing for decades. It's the power of exponential growth. Another powerful way compounding works in the stock market is through dividends. Many companies pay dividends to shareholders. If you reinvest those dividends to buy more shares, you are setting up a cycle where your dividends grow faster each year because you own more shares. So if you reinvest those dividends to buy more shares, you are setting up a cycle where dividends grow faster each year because you own more shares. Reinvesting dividends is like a snowball rolling downhill, picking up more snow as it goes. The more you invest, the bigger your investment becomes over time. The longer your money stays invested, the more powerful compounding becomes. It's all about being patient. You can't expect to make huge gains overnight. If you are in it for the long haul, like decades, compounding can turn your initial investment into something much larger than you ever thought possible. Let's say you are averaging just 7% return per year. At this rate, your investment will double about every 10 years. So if you start investing in your 20s or let's say 30s and let that money grow until you are in your 60s, you could be looking at a significantly huge amount, all thanks to compounding. One of the greatest benefits of compounding is that it helps you weather short-term market fluctuations. Yes, the market can go up and down, but compounding thrives on long-term growth. So even if the market dips, your investment can still rebound and continue growing over time. Patience is the key. Compounding rewards those who let their investments sit and grow. So here is another bonus. Long-term investing often means tax benefits. Long-term capital gains are taxed at a lower rate than short-term gains. So by holding your investments for the long term, you keep more of your profits. Government tax you when you sell something. There is no tax for holding on to your investments. So why does compounding matter? Because it can turn small, consistent investments into substantial wealth over time. The longer you allow your investments to grow, the greater the compounding effect. If you start early, you give your money the most time to grow and you set yourself up for success. It's why people often say the best time to invest was yesterday and the second best time is today. Remember, compounding isn't about making quick money. It's about consistent long-term growth. Let your money work for you and give it time to do its magic. If you found this video helpful, make sure to give it a thumbs up. Don't forget to subscribe for more investing tips. Drop your questions or thoughts in the comments below. I would love to hear from you. See you in the next video.